I see that our number is starting to climb, and I know that we have a lot of content to get through. So welcome, everyone. We're ready to get started with today's webinar. I'm Allison LaForgia, the Senior Webinar and Events Manager at HW Media. Today, our topic is 6 steps for lenders to reduce the cost per loan and increase margins with appraisal automation. Now, today's webinar is brought to us by Reggora. A few housekeeping items before I turn things over to the panelists. We will be having a Q&A session towards the end of the webinar. You can submit questions at any time by clicking on the Q&A icon at the bottom of your screen. HousingWire will be sending a recording of today's conversation in the next few days. Now, before we get into today's content, I want to let the panel introduce themselves. Jennifer, let's start with you.
Hi there, I am Jennifer Forche. I am a principal consultant with the STRATMOR Group. I have been in the mortgage industry since, 1998, so been a little bit. I've been with STRATMOR for about 10 years, and at STRATMOR, I mostly work on in the operations advisory area. So that means I do a lot of operations strategy assessment and planning, a lot of process design, and work with lenders on technology implementations.
All right, thank you so much for joining us today. And Cliff?
Thank you, and good afternoon, everyone. My name is Cliff Megason. I'm coming to you from the great Commonwealth of Massachusetts. I was most recently with Citizens Bank, where I was the head of collateral risk management, but I've got a deep experience in all things appraisal related. Like others on this call, certainly multiple years of experience in mortgage lending all the way back to HVCC and AIR days, if you remember what those were like. But looking forward to speaking to everyone today about ways they can improve their operational efficiency and reduce costs and contribute to their bottom line. Thank you.
Thank you for joining us. And last but not least, Brian.
Hi, everyone. Very excited for today. Apologies in advance. Had some logistics issues right before this, so I'm just calling in. Hopefully we can get the video going soon here. But yeah, super excited to get going today, talking about how to reduce cost per loan and increase appraisal automation. So thank you for the intros. I think that we were planning on starting with kind of the hot topic of appraisal modernization, and then we have individual categories of different ways. You can see here 6 different steps the lenders can take to reduce cost. So on this first note of appraisal modernization, and just to give context to folks in terms of what we're referencing here, this is primarily around all the new types of appraisal products that the GSEs are either have already put out in the form of like desktop appraisals or PDRs from Freddie, or some of the new products that are coming out on the horizon, like hybrid appraisals and other inspection-based waivers. So to start, I guess, Cliff, we can go with you first. What do you think are the key things that lenders need to, be mindful of when just thinking through their overall appraisal modernization strategy?
Thank you, Brian. I think it's an important point, and this first bullet point kind of speaks to that, right? It is critical that lenders find the right partners. In my experience, I've certainly seen where, you kind of start going down the wrong path, and you can, introduce all kinds of operational inefficiencies and unnecessary cost and waste that can really be improved by finding the right partners at the right time. So I know the platform has a lot to offer in that regard, but from a lender's perspective, I think finding the right partner and making sure that there's a good fit for your culture, for your risk appetite, and more importantly, technologically and operationally, how good is that vendor going to be able to support you? I think is critical for managing your costs.
Yeah, so that seems like definitely, obviously, number one, you need to be able to actually fulfill these new products, right? If you are only used to managing a panel of appraisers directly, and suddenly you need to engage third-party, field service inspectors or data collectors, you need to figure out, how you're going to do that. But we've also run into, lenders who may have partners that are able to do that, but then they need to come up with all these kind of internal policies and procedures, when they're going to do them, when they're going to not. So, yeah, any tips or thoughts in terms of the lenders thinking through the actual policy side of things?
Yeah, I think when it comes to a policy perspective, you want to make sure that you understand what your organizational risk appetite is for these products, because let's be honest, they're going to be new to everyone, and in some cases they're introducing a whole nother entity into the chain of custody, so to speak, right? Because now you've got this idea of a property data collector. What is their role? What are they responsible for? When you've got the appraisers on the other side completing the reports, what are they on the hook for? And then ultimately, as the lenders, the ones that are originating these loans and the ones that are going to own the risk long term, what are you doing to make sure that you've done your due diligence throughout that manufacturing process to meet those investors' guidelines? So you want to make sure that you really understand clearly what you're on the hook for, and that you've got partners and vendors in place for making sure that they've got you covered and that you understand what they're doing so that you're protected at the end of the day.
Yeah, the only thing that I would add to that, outside of the actual kind of hard and fast compliance policies and procedures and making sure that the products work with any of the investors that might get sold, we've also seen like workflow decisions that need to get made. For example, where what happens if a loan qualifies for an alternative appraisal product, but the borrower actually wants the full appraisal, or loan officer XYZ doesn't feel comfortable with the new products and wants to do something else. What are the actual workflows around who's going to be ordering the product and who signs off on it and things like that? So it seems like there's quite a different spectrum of things that need to get nailed down, but obviously super important when it comes to staying competitive with the rest of the market here. And you don't want to be the only lender not offering these alternative products. So so lots to check off there. Anything else that either of you wanted to add here?
I'll jump in real quick on that. I very much agree with and appreciate your point about all the what are the workflow complexities. In general, if we could pick the way we wanted our loans to go, they would all look like widgets. They would be identical, and we would know exactly what to do in every case. But unfortunately, we don't have that luxury. It is very easy to overlook how complex a what seemingly simple process can become. And so you do have to be very careful when you're looking at what you're ordering, what your options are, that you've accounted for that in your workflow, that you've accounted for that in your system configurations, and really took the time and thought to focus on how you can streamline that and make that work well. I often see lenders in that scenario where kind of a couple of months into it, they start to realize how many glitches they've created for themselves.
Yeah, you never start too early. Awesome. Well, like I said, we wanted to cover kind of some of the general high-level things to be thinking about for appraisal modernization, but really take this webinar to focus on actual tangible things to improve costs and automation. And so if we can start with the next slide, here's where we'll get into some of the actual tactical things that really drive ROI. And so you'll see here at the bottom of these slides, actual dollar amounts that have been tied to various improvements that we've seen lenders make, that you can save up to X dollars per loan, depending on the lender's setup and what the actual thing that's happening in terms of improvements. So appraisal reviews, going to start here as a large category. Jen, I guess we can start with you again. What are some of the most important things here that we've seen in terms of improving appraisal reviews?
I think you have a lot of opportunity to use scoring, whether you're using collateral underwriter or ACE or a third-party analysis tool, but to use that to really route and think carefully about how much review is actually required based on those scores, and to route those files out to the appropriate people. So I think there's a lot of opportunity there. We've seen a lot of good results from lenders who have focused on that. I would say it's key that happens sort of automatically, so that your system can detect those scores and make a decision on the right path that the review should take. And then secondly, enhancing that review with automated tools wherever you can. So either the review is automated, or you've provided some sort of tool that makes it very easy for the reviewer to make a decision on whether the appraisal is meeting the needs or not. So I would say just looking at how you route, looking at who you use to review different types of appraisals is a great first step to getting some lift.
Awesome. And Cliff, obviously you oversaw this at an actual highly regulated depository. What are your thoughts on ways that even for those, highly regulated folks, that you can improve some of these measures?
Yeah, thank you. And I would certainly agree with what Jennifer just shared a moment ago. But I would add to that a real area of opportunity for lenders is in that revision space, right? The 1 in 4 appraisals having a revision request. I know that that number varies, by lender, and I would challenge everybody to really understand what that number is for them. And then is that a number that they can ultimately be comfortable with? Because you're probably not going to get that to 0. If you drive it to a 0 revision rate, you've probably gone too far, but it also shouldn't be outside of what you're ultimately comfortable with, because at its most basic level, some of those revision requests, from a purely process management or process improvement perspective, that's a defect loop, right? The appraisal report was written in such a way that you needed to kick it back and start a whole nother cycle of work that is really inefficient, costly, time consuming. And ultimately, we talked about this a little bit before, it really impacts the customer in a pretty negative way, right? Everybody's already on pins and needles about the appraisal, and then you get it back and say, but wait, we're not comfortable with it yet. We have some questions we need to go back and clarify with the appraiser. So I think it's important for lenders to really understand what those revision rates are, leverage automation, understand what your risk appetite is, and not condition every report that comes across your desk. But don't hear what I'm not saying. That doesn't mean don't condition any either. Automation or technology can certainly be brought to bear to help with this, but lenders should really be looking very closely at that number and making sure that they're comfortable and identifying the right kinds of reports they want to, have those revisions made to, and not chase, unnecessary work.
Yeah, just to summarize kind of the balance of both of what you articulated, it seems like, obviously the underwriter is like one of the most expensive employees in the, mortgage business, which is why this savings number is so high. And so it's important to have some sort of high level, waterfall style flow where they don't have to like hand review every single appraisal. And so you want to bake in some upfront automation around, scoring and routing and things like that. But to your point, Cliff, you also want to make sure that it's not just a free for all, especially, I think that you've brought up, this is a time where there may be some higher scrutiny and a higher probability of potential repurchases, just in terms of the way that the market's going too, right?
Right. Historically, that's what we've seen, right? When the market tightens up, there's less volume, and the investors are taking a more closely look at the loans that are being manufactured. The appraisal is one of the areas where they tend to lean in the most. So lenders are going to want to make sure that they're doing the right thing the right way at that kind of stage of the manufacturing process. But they could expect probably a bit more, feedback from that, on the appraisal from the investors, going forward than they have over the last 18, 24 months.
Yeah. Awesome. Well, I'm sure we'll get a bunch of questions about this at the end, so we can certainly circle back. I know there's a lot of common questions around like, do you, what's better to have a dedicated collateral underwriting team versus kind of more generalized underwriting team that also looks at collateral, but clearly review a big one. So we'll probably end up circling back to this during the questions. I think we have a few more here. So if we go to the next slide, I think we have another bucket under the general vein of order allocation. And this graphic that we're looking at here is actually from a STRATMOR report. So Jen, I guess, do you want to first maybe set the stage of what we're talking about here and why this one's so important?
Yep, sure. So we did work with you, Reggora, on getting some information on what's the behavior of the appraisal orders, how are they performing. This is a few months old. It was kind of done in the worst time to get appraisal. So hopefully things are improving for folks a little bit. But what you're seeing here on this particular graph is that it's taking about a little more than 3 days to find an appraiser to even accept the appraisal. And then finally looking at an average about 10 days to get that appraisal back to the underwriter or to the originator, I should say. So that's what this data is showing us. There's some interesting information. I'll kind of segue to your next bullet, if you don't mind, Brian, about the AMC versus the panel, because we do want to talk about that just a little bit. So we have a lot of lenders who are kind of in that decision point of, do I want the panel or do I want the AMC? Some have long-standing panels. So we did take a little bit of a look at, how's that performing? And our data did show that panels don't perform as quickly, but of course there are lots of other trade-off benefits in that area. So we can dig into that just a little bit too. I don't want to jump ahead without you, Brian, so just let me know if you want to dig into that.
I think that's a great place to start, because I think a lot of people think about, what are those trade-offs, what saves me money versus improves turn time, and how to think about that. So I think it's, for sure a good area to focus on.
Yeah, so the panel versus AMC is really interesting, and we've been getting a lot of feedback from lenders who are participating in the STRATMOR workshops that we host. And the sentiment that we're hearing is, where lenders can use panels, they tend to favor them, even though our data showed that they don't necessarily perform better on a time perspective. What we are hearing is that the relationship is just so much tighter. So when things get a little tricky, the communication is much cleaner and faster. You kind of have that rapport with the appraiser, which makes it so much easier to resolve any issues. And there seems to be a higher level of commitment to try to please the lender, if that makes sense. You still have to have an AMC. I don't see that many lenders who can go 100% panel, because you do get that odd, property in an area that's not in your footprint, or an unusual property, or you just run out of panel appraisers and need some backup. So I think most do have some sort of mix of appraiser, AMC, and panel. But it's an interesting trade-off with the panels, and we do see a lot more lenders starting to wonder if a panel wouldn't be a good choice for them to enhance their AMC model.
Cliff, any thoughts from your side?
Yeah, thank you. Again, I think the STRATMOR participants are spot on in that regard. I think it's sexy to think about setting up your own panel and having that direct line to the appraisers, but there's a little bit of be careful what you wish for, right? Because my experience in talking to folks in the industry is that those who have set up panels certainly understand that there's a cost involved, right? Because now you've got folks that need to be that intermediary between the order being placed, chasing the appraisers. That's not going to change. The communication, yes, you own it, so it's improved from that perspective. They're not wrong, but that means you need somebody to manage that communication and somebody to actually make those phone calls and do that outreach. All critically important, but that theoretically was part of the large value that AMC's brought to it, right? Was they've got the internal capabilities and structure and resources to do that. So from a lender's perspective, it can certainly be a real benefit, but just understand, we're talking about cost and margin and bottom lines. Make sure you understand what kind of hidden costs you're taking on when you do that, because your revision rate's not going to go to zero with a panel. So you're still going to have some back and forth. It will be improved if you can get direct, but there are still concerns and thoughts that you need to have and be thinking about, who can reach out to that appraiser for those revisions within your operation shop, right? Who's going to be the ones that's going to be reaching out? How is that communicated? How is it done in a compliant manner? And more importantly, when the order isn't picked up on time, or the appraiser missed their appointment, or they got a flat tire on the way to the job. I mean, all of those things are going to come up. You're going to be, as a lender, when you're managing that panel direct, you've got to let your borrower know. And so, you can delegate that to an AMC in a number of places, and it seems to work well. And we kind of know what that looks like. We have years of experience doing that. But I'm not saying panels are bad. I'm just saying, know what you're signing up for. Go into it eyes wide open, and make sure that you understand what it's going to do to your cost per loan for the panel procured appraisals versus the AMC ones.
I'll tag on to that. You're absolutely correct, Cliff. There are more things you have to think about. And I will say that the appraisal management tools really help with that. It's not a huge hurdle. You just do have to be careful. Cliff is absolutely right there, but they really do help, and they help manage not just the panel versus the AMC, but multiple AMCs perhaps. So those tools are a really great addition if you don't already have them. They really ease that process quite a lot.
Yeah, and that was what I was just going to add here in terms of anyone looking at this slide, thinking through what Cliff was mentioning in terms of like, how does this actually translate to cost per loan and margin. What makes up some of those costs were things like, yeah, people following up on orders and loan officers needing to, email people and take time out of their day to say what's going on with this. Did we get it assigned? Oh, we have to do a rush fee because we couldn't get it figured out. And all these things, add up. And so there are these various trade-offs around performance. And it's an interesting time because I think that whole transition trend of people wanting to, go from AMCs to appraisers came from the 2021 chaos of all these orders going off track. And Jen, you mentioned, like, when you own the relationship with the appraiser, they help you out in the pinch. Well, like, all of 2021 was a big pinch, And so, like, the lenders who had those relationships, I think, had less like deviation of like random orders taking 3 weeks to get done, sort of thing. But then to Cliff's point, in kind of quieter times, there's less of that happening. And so when do you make that investment though? Like, is it better to do that investment now so that you're ready for the next one? And, so just understanding all of those costs definitely matters here, but it is a big deal. Cool. Well, I think we have another one here. If you want to jump to the next slide. Some more interesting stats coming from these. Jen, did you want to summarize any of these for us? I think it was from this, obviously the same study.
Sure, it is. So at the time we had 1 in 5 appraisals coming late. And incidentally, we did some other research work around the time we collected this data and asked lenders about what causes closing delays, and those were all 1 in 8. It's in your data too. 1 in 8 were delayed because of the appraisal, and we're actually finding that number is increasing. So lenders are doing a better job meeting closings when they're not having to wait for the appraisal. So it really just highlights how critical that appraisal delivery is. And then 1 in 20 borrowers walking away due to the appraisal. And if you've been following the news, we're seeing a lot more of that, borrowers walking away on contingencies and things like that, as the seller's market is starting to cool off a little bit, and borrowers having more control over the price. So yeah, we're seeing some really interesting data there on the appraisal and how it impacts the loan closing.
Yeah, so obviously to those costs that you mentioned, if you miss the closing, if you miss the rate lock, if there's fee escalations because you have to rush, all these things add up. And so Cliff, from your perspective, what role does the overall data and reporting element, performance monitoring, play into trying to improve some of these metrics?
It's absolutely critical. One of the things that, I would tell lenders that are listening to this is know your data, right? Know what your data is saying before your vendor has to tell you, or before somebody comes and asks you, right? You've got access, what your open orders are, what your timeline looks like, what's overdue, what's coming due, all those things. Kind of stay on top of it. And I think good reporting and good analytics coming out of your data miners, your data scientists, is critical, because too often we rely on partners or vendors to kind of report on themselves, and that has its place, and it can certainly be helpful at times. But when you know your own data yourself, and where your pain points are, it can really be a significant lift and view into what's going on. Because as Jennifer talked about, if you want to talk about, impact to your bottom line, let a transaction get as far as the appraisal and then fall apart. And what have you lost? Like the sunk costs at that point are just extreme. And so, to the extent that we want to improve customer service, improve the borrower experience, make sure those loans stay sticky, that they stay with the lender, they don't move somewhere else, stay on top of those orders. And you do it by having good reporting, understand what your SLAs are looking like, and then manage your vendors very tightly. So whether it's AMCs or direct to panel, you've got to be on top of your open orders, which ones are late, which ones are coming in late, why they're late. And then the communication is key. I mentioned before that the appraisal is one of the scariest parts of the whole process. And, borrowers feel, let's be honest, listing agents feel out of control. Borrowers are out of control. Your loan officers and those guys are all out of control. Everybody feels like this is something that they can't get their hands around, and yet can bring the whole deal crumbling down. So if you're responsible for the appraisal review procurement function, you've got to use the data available to you to understand where your weak points are, shore them up a bit, and really hold your vendors accountable, because you've got to get those orders in, good or bad. You've got to get the information in the door and decide, an update that says, well, let me see what I can find out, or I didn't know that one was overdue. Those aren't signs that you're probably managing the data as tightly as you should.
Yeah, I'll tag on to that, Cliff. I totally agree with you that you need to do your own reporting, own your own data. It must be independent. There's just so many benefits to that. I would also add that you have to approach the appraisal monitoring the same way you should approach the rest of your process, in that you should have some preconceived thoughts about what's acceptable to you and what you're going to do if you fall out of that acceptable range. So, if A happens, we will do B, and if Z happens, we will do X. I think it's lenders need to sit down and kind of think about that. I tell the analogy of, it's fine to watch the news and learn that the hurricane's on the way, but that's not the important part. It's what's your reaction to it. How bad is this hurricane? Am I leaving town? Am I staying in town? You have to know what you're going to do with the data when you get it, and know when to recognize that you've got a problem ahead of you. So I want to echo that about use your own data, but also plan what are you going to do with it, and what are your tolerance levels and your plan for when you start to either approach that threshold or cross that threshold. And again, that's true all across your process, but we tend to kind of forget sometimes about holding our service providers accountable in that same way.
Yeah, this one's interesting too, because I think there's differences in lenders where, like, I'd say this is more frequent in the distributed retail, where the branches are the ones who decide on which AMCs get used. And I think that there's this old school mortgage mentality of, hey, I have this really great relationship with this AMC. They always do me good, but they don't have the data to actually see oh, actually this AMC isn't performing as well as these other two in this area. And yeah, to your point, you can't do anything about it if you don't have that information. So arm yourself. Don't ask them for it. It's almost like asking the barber if you need a haircut. You need to control it yourself, and then figure out what you're going to do if they actually do step outside those SLAs, and what alternatives are there. So cool. The only other thing that we were, I think, planning on talking about in this one that I wanted to flag was with all of the recent conversation around appraisal bias, there's been, some crackdown in terms of understanding this data and being responsible for it. So for example, what is your percentage of ROVs in XYZ area? How does that compare across demographics and things like that? So being able to have actual answers for this stuff is going to, make it way easier down the line when some of this, the bias area gets way more attention. Cool. All right. Well, we can go on to the next one here. So communications. So I think we've kind of touched on some of these throughout these other slides, but I think this is supposed to be around just the overall category of following up with the appraiser or the AMC in terms of what's going on, coordinating on the inspections and all this sort of stuff. So Jen, what do you think here were the most important things for lenders to be aware of and try to improve?
Well, I think one is related to that reporting and monitoring. It's just knowing where the loan is in the appraisal process and being able to follow up when you should. So when things are beginning to approach a due date and you don't have the appraisal delivered, you should know that with some advance notice. You don't want to find these things out late. So that would be the first thing. It's just building on that concept that you need to have the data and the reporting at your fingertips, and the tools can help you with that. That's one of their primary purposes. So that would be the interface that you could use to manage that. I would also add to that this communication with the realtor and also the internal communication can be a really sticky point. It is very, very common for me to hear from lenders particularly processors, that they kind of get caught in the, the realtor calls the borrower, hey, you should call your lender and ask for the appraisal, or the realtor just calls the lender directly and says, where's the appraisal? So the processor then might have to go out to the appraisal group, ask for an update. The appraisal group goes to the appraiser, and then it follows the chain all the way back so we can give some update to the realtor. So I think an emphasis on trying to streamline that. And what that means is give the visibility to the right people. So if you can give visibility onto the status of the appraisal to the directly to the realtor, maybe through a realtor portal, try to do that. Try to give visibility to your processors and loan officers who are watching those things, and avoid sort of that telephone game that's really, really common in the process. That is what's going to minimize all that chasing. It's going to make realtors feel better about this really scary part of the process. And it's going to make everybody's job just easier and quicker. So all of that contributes to cost. That would be a major focus that I would advise any lender. If you don't feel like you've nailed that, focus on that.
Cliff, what are your thoughts on communication? I know usually from the appraisal admin seat, a lot of that communication is not just to the vendor, but also with the loan officers and production staff as well. How big of a deal is this general category of things?
It's honestly one of the biggest challenges lenders face today is the communication piece, because as Jennifer mentioned, a good number of lenders have that. And regulators, kind of look for this, right? This wall between the appraisal group and everybody else. You don't want any, inappropriate communication or non-compliant communication taking place. So that's where the protection comes in, right? But with that protection comes lots of breaks in kind of the chain of communication. It ends up being the worst game of telephone you can imagine. You almost think if you took 2 cups and string, you'd be better off, because Jennifer's right with all the handoffs. But if there's a step where it falls apart, let's say all that happens correctly, the realtor calls the LO, processor who calls the LO, who calls the appraisal group, who gets a hold of the AMC, who gets a hold of the appraiser. If you just think about all those connections I just made, then you need to reverse it. Any breakdown in that entire process results in effectively what is a communication black hole, right? I sent a request in, I never got a response out. Why is nobody updating me on the status of my order? Why do I have to tell you? And again, we just talked about this a slide ago. Why do I have to tell you that it's due tomorrow? Where is it? Or that it was due 2 days ago and I don't have it yet. All of those pieces ultimately result in communication. And you can fix a lot of bad parts in a process with good, timely, effective, accurate communication, but you can make all situations worse by bad communication, untimely communication, breaks in communication. And yes, the technology can absolutely help. We talked a little bit about this earlier. There are solutions that can help with that, managing that communication back and forth, but knowing who can be communicated with and how and in what manner is critically important. But I think this is the one thing that separates the great lenders from the good ones, right? The ones who put the communication in the right person's hands at the right time so they don't feel like they don't know what's going on. Oh, and by the way, the extension is that you as the lender don't know either, really improves the customer's perception and expectation, and really their overall evaluation of the appraisal review and procurement function, which at the end of the day, they're going to extrapolate to the relationship with the entire entity. So we need to take that communication seriously, make sure we leverage the technology and tools that are available to us, and make sure that it's timely and accurate, and more importantly, followed through upon, right? Make sure that, all the links in the chain are updated, not just that it goes to point 1 of 10 or 3 of 10 and stops there.
I want to tag on one more thought to that too, is I think it's important to think about how the communication is relayed, because, Cliff and I both talked about the phone calls and the email chain that goes all the way to appraisal desk and all the way back up. I think it's important to look for techniques or strategies for how to deliver this information on demand. So I would love to see the email inquiry go away. So the realtor calls the processor and the email chain starts. I would love to see instead a way for the processor to say, well, let me look at the Jones loan and find out what the situation is, and be able to do that instantly. The instant that we have now is I can instantly send an email, which is not ideal, Or the most common alternative, or the most common solution for that, is for automated emails to start going out. Okay, processor, you want to know if it's been ordered? I'll send you an email at the moment that it gets ordered. That is a great tool. But when the realtor calls me and I'm a little bit under the gun and I'm in a hurry and I don't have a minute to search my 4,000 emails a day, I want to go somewhere and be able to see this. That to me is a far better scenario for the processor to be able to provide that service to the realtor or the loan officer or the borrower. So I would advise, as you're thinking about your process, as you're thinking about what data you make visible, not necessarily editable, but visible to the users on your system, think about whether you could provide that sort of ease and efficiency to those folks who are actually looking for the information.
Yeah, that kind of transparency would be really powerful, I think.
Yeah.
Well, it sounds like it's also more relevant right now in like a purchase market where, first of all, like everyone is just trying to keep loan officers, recruit loan officers. And so you want to do anything that you can to improve that experience, but also the realtors who are like, sourcing a lot of these deals, you want to give them a good impression of, hey, this lender like really has their stuff together. They're extremely transparent and very good in terms of communication when it comes to the appraisal. So, it is interesting. A lot of people don't think about like, can my appraisal process actually improve my top of the funnel? But there are just these like tiny little things everywhere that contribute to it. So definitely really interesting. Awesome. Well, I think we have one more big chunk of topics and then we can dive into, I see some questions are already rolling in, so we can start answering some of those questions. So the last one here is payments, and you can see there's a big number attached to this one at the bottom. There was, a lot of issues with payments, some interesting trends here. Yeah, I guess we can start in the reverse this time. Cliff, what are the top things that come to mind for you when it comes to issues with the payments and how, lenders can reduce costs here?
I think ultimately it is one of those things that if you've got a good handle on it, you certainly will be able to be more efficient. So here's what I mean by that. The lenders who know their vendors, know their process, and know the fee they're paying and can really hold their vendors to those fees, it's going to be critical. I've certainly seen instances where if lenders don't have a good idea of what they're disclosing as far as an appraisal fee, for example, and then you get a lot of these revision requests where the appraisers, the AMCs are coming back and saying, I need an extra, X amount of money to complete the order, to place the order, whatever. Those are the things that if you don't have an outstanding ironclad process for tracking those changes, making sure that they're disclosed properly, the consumer's given their adequate information up front, you're going to find yourself as a lender having to potentially absorb some of those fees in the back end. And that is a direct hit to the bottom line. So understand the fee variances, when they're occurring, why they're occurring, and have a very, very good process that contemplates them and accounts for them, because it isn't a matter of if there's a fee variance. We know that there's going to be one, but when there is one, how does it properly flow through our process to make sure that we're disclosing things and not creating a liability for the organization when that loan, subsequently moves to closing. Because that is a real dollar, end of the day cost that would potentially have to be borne by the lender. So you're going to want to be very careful about that. And I'll use this opportunity to say that, we talked at the outset of the call about appraisal modernization and the bifurcation, the, data collection reports and all of those kinds of things. There's a lot of things that are going to be solved by that. But I think the jury's still out on what the impact of that is going to be to the overall cost of the appraisal, right? Because now in some of these cases, when you have a bifurcated process, you're going to have another entity involved. They're going to want a fee. Are the other parties going to reduce their fee to account for it? That remains to be seen. So, I think the jury's still out on what impact that's going to have on the appraisal costs going back to the consumer, because in the majority of cases, the consumer is the one paying the appraisal fees. But lenders are going to have to decide for themselves how they kind of absorb that new way of getting collateral evaluation data into their systems, how they want to position that from a fee perspective. But understand what your fees are, understand your variance rates, and more importantly, when there are variances, make sure you've got a really good process for making sure they're properly documented so you don't end up having to absorb it on your side.
Jen, your thoughts?
Yeah, I'm going to tag on. Great points, Cliff. I think the trick is that how do you figure out what the right fee is up front, and that can be really tricky. And especially, I hear just nightmare stories from so many lenders who are in some more unique markets, and how much research it takes for them to quote a reasonable fee. If you're on a lake, is more expensive than if you're not on a lake, those types of things. So there's a lot of burden on the lender to try to get that fee right up front. And Cliff, I think your points about appraisal modernization are really interesting. And it brought to mind, I said right up front, the lender's preference in every case would be that every loan was identical, which would mean every appraisal gets the same report, costs the same amount of money. And it will be interesting to see as we expand the options with the modernization, what kind of complexities that's going to introduce for the lender and how we deal with that. So I think the jury's still out on the right approach there, but I think it's something to really watch for. And then from a pure process perspective, ideally you would be able to initiate that borrower payment in the point of sale solution. So lenders have very different philosophies on how they want to collect appraisals, when they want to collect appraisals. Depends a lot on what kind of institution you are and just your general practices. But for those that want that payment up front, putting it in the point of sale system or in that interview or very early in the process, some lenders may want to wait until make it a prerequisite to get the loan submitted for underwriting, but building that into your process and then triggering it in an easy way. So when you hit the point at which you want to collect that payment, then you need to present that option to make the payment to the borrower. Again, the point of sale solution is a very good place to put that if you can. And if you can't, work on a good way to do that. So I think there's two things going on from a process perspective. It's how do you make it easy and quick and timely to actually collect the payment? And then from the cost perspective, there's how do you get the payment estimate correct? And it's a challenging problem. So I don't have the solutions to that other than we have to pay a lot of attention to it. You should give it a lot of thought and attention.
Well, I just realized that I didn't even introduce Reggora in the beginning. But as so my company provides appraisal management software. So the payment workflows are near and dear to my heart, both in terms of just we've spent way too much time. This is one of the biggest problems for lenders. And just to give folks some of the tactical workflows of how you get to that $91, just to point the various items that Jen and Cliff both mentioned. So there are some lenders who process their own credit cards, and therefore they are eating the credit card fees associated with that, which is usually 2.5, 2.9% of every single appraisal, can add up to tons and tons of money every year. There are instances where you don't disclose correctly up front and you have to eat a different fee because it's not a valid change of circumstance. There are some lenders who don't have a good change of circumstance flow and eat every fee associated with an increase. There's obviously payouts to the vendors where if you have an accounting department who is cutting thousands of checks, then that costs a bunch of time and money to do. And so there is a huge amount of different areas around this, and certainly requires, in my opinion, some technology partners to help tackle on these fronts. And then actually, Jen, from the study that we did here, we didn't talk about it, but on payments specifically here, we're just circling back to that interesting panel versus AMC conversation. It seems like there's some dramatic differences around these fees and escalations for panel versus AMC.
Yeah, which makes sense. That kind of goes back to that tight relationship and trying to be kind to each other to maintain that relationship. It would make sense that a panel appraiser might be more forgiving on some of the fees because they have that relationship with you and that commitment from you. So that was really interesting data. I agree. Awesome. Well, those were the 6 categories of
areas for cost improvement. So we can shift to some of the Q&A here. I know we had a few questions come in. So let me just pull those up first.
Yeah, Brian, I can toss those to the panel, and just a quick reminder to the audience, there's still time to submit your questions. So if there are any questions that you have for Cliff, Jennifer, or for Brian, drop them in the Q&A. We're actively keeping an eye on them. But I think a good question to start with is, do we have a demand and supply issue? Not many appraisers in the market.
Yeah, well, I'll take that one. And I'm sure Cliff has lots of thoughts too. We definitely do. I mean, you continually hear from the appraisal industry, that the long ramp it is to get certified or licensed, I should say, to do appraisals. So there's a lot of barriers to entry. And I would say that we had a supply and demand problem for all things related to loans in the last 2 years. I mean, we had title issues and all sorts of things. Everyone got backed up. So there's definitely supply and demand. And I don't see that changing soon. I think where you're going to have some relief is just that the market's going to slow down, which is an unfortunate way to solve that problem.
Yeah, you're right. I certainly agree with Jennifer. It's certainly still a problem, and it's going to be a problem. I know that there are efforts being made, by various industry participants to drive more people to the field, to the profession. But let's be honest, if you kind of talk about what it means to be an appraiser, for the ones that are going out there, let's just talk about in traditional sense, they spend all this time at a home, completing the report, doing all the analysis, doing the work, only to send it in to have the lender tell them the report's wrong. And if the value doesn't come in where somebody else thinks it should be, they get told the report is garbage. And then it is a tough job. There's no doubt about it, right? If you think back, and this is, somewhat my age, but if you go back before there was collateral underwriter, all these amazing tools, appraisers had a lot more independence, in the sense that there wasn't as much oversight or review of their work in a quantitative and qualitative manner, for that matter. So they're getting a lot of scrutiny today that they didn't used to. And so you look at it as a profession, you say, yes, sign me up to have my work constantly questioned, constantly called in, into question. And then more importantly, once a loan is made, manufactured, and sold, I still could get, a follow-up from a lender on a repurchase demand. So I'm talking about reports that, I did 6 months ago, and still having to write, explanations for why I did a particular report a certain way. Like, the liability tail on these things is very long at times. So there absolutely is a supply and demand issue. I think that's part of the reason for appraisal modernization. They're hoping to skinny down the amount of work that the actual licensed certified appraiser has to do to the smallest amount, so you can get, this is going to sound terrible, but the most juice out of the fruit, right? Get the core group of professionals that provide that service, and only ask them for that which they must do. And I don't think an appraiser's highest and best use is driving 30 minutes to a property, or crawling around a property, measuring foundations and walls and heights and windows and counting rooms. Like, there's certainly aspects of that are super important, but I think there are those in the industry who feel like that work can be done by others. And that's part of the reason you see the bifurcation, and the idea that we could have that data collected by somebody else, but let the experts focus on what they're best at, which is determining value based on other market intelligence, and leveraging them in that way. Does that make sense?
I think it does. And I want to make sure that Brian gets the opportunity to jump in here. Brian, do you want to wrap this up?
No, I mean, I think, they both kind of summarize my point of view. I am optimistic that appraisal modernization and the reduction of the scope of the appraiser will allow for, a new supply of individuals to come into the industry. And so, we'll just have to wait and see, the breakdown in terms of what percentage of orders go to what types of folks.
Absolutely. So the next question that we have is, what is the optimal number of AMCs on a lender panel?
I guess I'll jump in first. It's really going to depend on the level of service you're getting. So you could argue that. So let me give you the high level view of from a lender's perspective, how they evaluate that question. First is, what level of service are you getting from the vendor that you have, and how much of your wallet share are they getting? Because let's be honest, if you have one AMC and they're getting 100% of your orders, you mean more to them than if you spread those 100 orders over 10 AMCs, where each one you only represent 10 orders a week or 10 orders a month or 10 orders a day or whatever it is, right? So you've got to find that balance between, are you sending enough volume to a vendor participant, to an AMC, to be important to them? Because at the end of the day, they're running a business too, and they're going to take care of their big dogs first, right? The folks that are most important to them. So how do you stay an important client to your AMC partners? That's the level you want to operate at. At least that's what I've seen work well in the past. So the answer is going to say it's terrible. It depends. It depends on how many orders, what your tolerance is. You could also say, I don't like all my eggs in one basket. I don't want to be beholden to just one AMC. That's got its own risks. So I want 2, or I want 3, or I want 5. They are all important and play an important role, but AMCs vary in terms of their ability to deliver by market. So that's the other, it depends, right? In some cases, in some markets, AMCs do extremely well, and in some areas, not as well. And that's where you've seen lenders go appraiser direct, for example. It really varies geographically, but I'm guessing Jennifer or Brian have something to say.
I think I'm nodding to everything you say. I totally agree. It's about balance and what you can actually do. So I started in the industry with a secondary marketing focus, and our mantra was always, you have to have 2 execution options for every loan product. I would say it's kind of the same thing. You need to have at least 2 appraisal options if you can do that and give enough business to an AMC for them, your business to be meaningful to them. So it is, I don't think there's a single answer for that either, unfortunately.
Yeah, we actually have some data around this, because we deal with like 100+ customers and can see what's working and what's not. To Cliff's point, it's not like a perfect silver bullet answer, because it depends on the lender volume. I can give some pretty silver bullet answers though. I think that anything over 10 is way overkill, like way too much, and becomes a nightmare to manage, and usually isn't optimizing actual performance. And then, to Jen and Cliff's point, having just 1 or 2 is also difficult, because you're kind of beholden to them. And going back to the data and reporting area that we talked about, if you don't have an actual alternative to go to, you can't like punish someone for not performing well, right? So I think that the blanket answer that I'll commit to is for like small to mid-sized lenders, if you're going to use AMCs. This is only if you're using AMCs. Obviously different if you're going direct to panel, but for the lenders who make the decision to use AMCs, I'd say small to mid-size, it's probably like 3 to 5. And if you're much bigger than that, probably like 5 to 10, and anything above that is pretty crazy in my opinion.
And this next one is for you, Brian. How does Reggora collect payment for appraisals? Do borrowers get a payment link from a company they've never heard of before?
No, we do white labeled payments. So to Jen's point, either it's embedded within the point of sale system, or we send out like white labeled emails so that the borrower knows it's coming from the actual lender.
All right. And then our next question is FNMA or FHLMC dropping the requirement for a standard appraisal base on certain loan parameters, specifically LTV or prior appraisal done, etc.?
So I'll start with that. I think both, and so the references there are to Fannie Mae and Freddie Mac, both of them are very black box-ish relative to what loans will not require an appraisal at all, right? That is their risk tolerance, their review of the data, their review of all things that they know, and they do that based on the submission to the underwriting engine, right? So, I'm not going to be crazy going on a limb and say, yes, it's going to expand, or no, it's going to contract. Those are levers they're constantly pulling as they see and evaluate the data that's coming to them. but just know that they understand the same pressures in the industry that we do. And so they're only going to make it when there is a good risk-based reason for them to do so, right? They understand what their risk tolerances are. They understand these loans and these transactions and the borrowers on a much more holistic basis than we do. And so when they look at it and they say, look, to qualify for an appraisal waiver, here are the things we want to see. That's entirely up to them. So could they expand it? Sure. Do I think that they would? My personal opinion, not to be taken as anyone else's, is that probably not, right? The volume is such that they don't need to expand on that. There isn't this, pent up demand, as Brian was talking about. The last 12 to 18 months have been a little crazy. And so if they were going to do it, one could argue they could do it there. And we all know what the allowances they made for COVID and kind of where they went then. That seemed reasonable to me. That seemed like a well thought out, executed plan to get us through some very difficult times as a country. But I don't see that those pressures are in place today to where they're going to significantly expand loans that don't require appraisals, because that's a whole different risk profile, right? There's a whole chunk of data they don't get when they don't get the appraisal. But Jennifer, do you have any thoughts?
No, I think you said it well. I tend to agree. I mean, they're not going to clue us in on what they, how they're making those decisions. And I also do think they do want to be and need to be very responsive to the current conditions. So I think if we see a lot of movement in the market, which I think we're seeing now, I think they're going to tweak that model. So I think it's going to continue to be a little bit of a mystery in terms of knowing or being able to predict which are going to get an appraisal waiver and which won't.
I want to give Brian the option to jump in. Are you good with moving to the next one, Brian?
Yeah, we can jump forward.
All right. So our next question is, in some markets, it may be more expensive to get a desktop appraisal or hybrid when there is payment to a data collector and an appraiser. Additionally, some lenders and appraisers are concerned about quality and liability. Do you see some markets where the desktop product is more popular?
I can give some preliminary thoughts here. So I think that generally the response to the desktop appraisal as it currently stands, which requires a floor plan, there hasn't been much significant adoption because of that floor plan requirement. And to whoever asked the question, to that person's point around usually still having to go and get the actual data. Where the desktop appraisals make more sense is if the floor plan already exists at the time of listing. And so in the geographies where that's a more common trend, there's probably more adoption for desktop appraisals. But just to clarify, for some of these newer products that aren't desktops, like hybrids, I think that there's pretty clearly defined, liability in terms of where that sits. And, there has definitely been improvements to cost and turn times on those. And I think that that'll become a much larger, a much more largely adopted product. I think the desktops as they stand today with the floor plan requirement probably won't tick up in significant adoption until the whole floor plan thing is pretty well solved for.
I'll just jump in and support Brian. I think he's spot on as far as that goes. When the requirement was announced regarding the floor plan, you just knew it was going to be challenging. And even when there's a floor plan, let's say with the listing, and they say, well, one's available. If you're an investor and you're ultimately going to make, manufacture the loan and then sell it on the secondary market, you have to think about how much reliance can you put on, that floor plan that was developed maybe by the listing agent, and how accurate it is or could be. So I think that's one of those things that it's a bit of a moving target. Nobody knows exactly where it's going to land yet. Brian's spot on in that it's been a point of contention. And I think part of the reason the desktops haven't been more successful is because of that. But there's a reason that they require them or that they want them. So I think that there's, smarter people than me that are figuring out, is there room to give on that, or is there not? And if there isn't, then what does the offering really do for us or do for the industry? And if it doesn't create a capacity, then, I could see a future where, those pivot yet again. So I think they're still tweaking. My personal opinion is that they're still tweaking. That's going to have to happen with that product. But Jennifer, what do you think?
I agree. I mean, when you think about it in terms of if you have a house selling for, say, $250 a square foot, and you want to kind of pad your value by 10 grand, that's just a few square feet, 40 square feet, I think, so that you would be able to, it would just be very easy. As a lender, trained to be a skeptic, I can see where it would be very easy to worry about that type of dynamic.
All right, well, we are at the top of the hour. Webinar time goes by really quickly. Cliff, Jennifer, Brian, thank you so much for giving us so much insight today and for answering all of those audience questions. If you submitted a question that we didn't have time to get through, we will be sending the questions over to Reggora, and they will be able to answer you after today's webinar ends. HousingWire will once again be sending out the recording to all registrants in the next few days, and the webinar will be available on demand in our Knowledge Center at housingwire.com. Thank you again for joining us for today. Hopefully we'll see you all again soon.